Okay.
You ready?
Yes, sir.
All right, in 3, 2, 1.
Good morning, ladies and gentlemen. Today we'll be looking at our paper one, balance sheet, note number 7 and note number 8, ordinary share capital and retained income. And then in addition to that, we'll be looking at the note where we correct the net profit after tax. And then lastly on this question, we'll be looking at a bit of audit reports. Now, without any waste of time, I would like us to look at at our question. It's question 1, company financial statements and audit reports, Pre-Donor Limited. Very important that before we can even start to attempt to do this question, to look at or read through the question so as to get when is the beginning of the financial year and when is the end of the financial year. That will be very useful, and it will assist us in our calculations, that our calculations can be correct. Right now, 1.1 says here, the following information relates to Pre-Donor Limited. The financial year ended 30 June 2015. The business uses perpetual inventory system. Now 1.1, we must now refer to information B. Calculate the net profit after tax for the year ended 30 June 2015. Indicate a positive for increase and a negative for a decrease. Now, remember I said to you, since our financial year end is 30 June 2015, it means the beginning of our financial year would be 1 July 2014. Right, now let's go back to our information B. Net profit before tax of 2,493,600 was determined before taking into account the following information, meaning we have to adjust this 2,493,600. This is an incorrect net profit. Now let's look at the adjustments. Adjustment number 1 says the trading stock on 30 June 2015 was valued at 191,900. Now we must go back to information A, where we check according to our records, according to our balance sheet, how much is the balance for our trading stock. It is 203,200. But when we count at the end of the financial year, our trading stock is 191,600. It is lesser than the balance that appears on our balance sheet. Meaning, in this case, there's a difference of 203,200 minus 191,900. Now, if what we are counting is lesser than what is on our records at the end of the year, it simply means that we have the trading stock. Remember, it is either after stock counting, it is either we'll have a trading stock deficit or trading stock surplus. In this case, because what we are counting is lesser than what what's on our records with a difference of 11,300, it means that is the trading stock deficit. Now, in your answer book here, you'll write trading stock trading stock deficit, and trading stock deficit, you know, it is in our income statement we record it under other operating expenses. So now we must now subtract the 11,300 from this from the incorrect net profit, and then we go to the next one. The next one, adjustment number 2, says provision for bad debts must be adjusted to 9,000. Remember, again with this one, in our income statement, our provision for bad debts adjustment can either be profit, can either be an income recorded, meaning in our income statement we will record that under other operating income, or if it is a loss, and then we'll record that under operating expenses. Now, let us check, because now they say here provision for bad debts must be adjusted to 9,000. Now, let us look at information A, where and then look at what we have initially made provision of. We have 11,400, but look at the adjustment. At the end of the year is 9,000. Our provision for bad debts, this is the actual provision for the for bad debt, which is 9,000. But we have made a provision at the beginning of the year of 11,400, meaning we have provided more. If we have provided more, it means now the difference will be in the income statement will be recorded under other income, because now we have provided more. 11,400 minus 9,000, the difference is 2,400. Now that we have provided more, it means now we must add back the difference. It means now we must add back the difference. Provision for bad debts adjustment. The difference is 2,400 rand. Now, if the difference is 2,400 rand, since we have provided more, it means now we must add back the 2,400 rand. It is possible, ladies and gentlemen, that say for argument's sake, we have provided lesser. Say our provision for bad debts, that number 2, is 11,400, and then from our balance is 9,000. Then it means now, in that case, we would have provided our provision would have been lesser, and then it has to be adjusted from 9,000 to 11,400. In that case, it would have been an expense. We could have subtracted it from this total of hours. But in this case, we have provided more. That is why we add back the difference. Right, now let's go to number 3. Number 3 says here, rent for July 2015, 2,800 had been received in advance. Remember, in the face of our income statement, any income that we have received in advance, we subtract. Any income that we still have to receive, we call it accrued income, we add. And then any expense that we have that we have prepaid, we subtract, and then any expense that we still have to pay, that will be accrued expense we supposed to add on our face of our income statement. Now, with regards to this one, this is a rent that we have received in advance. Rent that we have received in advance to the value of 2,800. Therefore, we will subtract. We will subtract here. We'll write here rent income, and then we subtract 2,800. Named 2 marks, 2 marks, 2 marks. Right. Now we go back to our adjustment number 4. An annual insurance premium of 6,000 was paid for the period of period 1 April 2015 to 31st March 2016. Very important. Let us look at the our financial period here. I said it starts from 1 July 2014 to 30 June 2015. Now this annual insurance premium was paid from 1 April. It was paid from 1 April 2015 to 31st March 2016. Right, now we'll look here how many months falls within the next financial year. That is what we are interested upon. Remember, our financial year end is 30 June 2015, meaning from July to March. Let us count. It is July, August, September, October, November, December, January, February, March. It is 9 months. It was this premium exceeded or proceeded to the next financial year by 9 months. That is what we are interested upon, and that will add back, because now what they did here, they've subtracted the whole 6,000. Right. Now, when you look here at, let us quickly calculate the 6,000. You can divide that by 12 times by 9. Right. Let's quickly look at that. It is 6,000. Right. This is for rent. This is for insurance. Sorry. This is for insurance. 6,000. We divide by 12 to get 1 month premium, which is 500, and then this 500 will you'll multiply by 9. Remember, it has exceeded to the next financial period by 9 months. So now you times by 9, you'll get 4,500. Or alternatively, you can say here 6,000 times 9 divided by 12. You'll still arrive at 4,500 rand. You can still arrive at 4,500. Remember, I said to you, what they did here, they've subtracted the whole amount of 6,000. That is why now we must add back the 4,500 rand. Right. Let's go to the next question. The next adjustment. It is adjustment number 5. The auditor discovered that the profit on disposal of a vehicle, 6,800, was incorrectly shown as a loss. Remember, this is a profit. It means in the income statement it was supposed to have been recorded in that section of other operating income, but instead they've recorded this under expenses as if it is a loss. Now, firstly, we must correct that. Either you must now add back the 6,800, and then that will be the correction of an error. That will be the correction of an error, because now instead of recording this 6.8 as an income, they've recorded it as an expense. That is why we add back. When we add back, we correct the error. And then lastly, we now record what was supposed to have been recorded. Remember, this is a profit. The profit in our income statement, it is supposed to be added under other operating income. So it will be 6,800. Or alternatively, somebody will just say 6.8 times 2, and then they will add back 13,600 rand. That will still be correct, right? Right. And then now we can now work out or calculate the correct net profit before tax. The correct net profit before tax, it will be 2,493,600 minus 11,300 plus 2,400 minus 2,800 plus 4,500 plus 6,800 plus 6,800. Now, the correct net profit before tax is 2,500,000. Now, the income tax, now we go back to our question, information B number 6. It says that the income tax amounts to 750,000 for the year. Now, remember, income tax, we subtract. We're supposed here to subtract 750,000, and then the net profit after tax will be 1,750,000. 1,750,000. Okay. Now we can jump over to our retained income. Now we can jump over to our note number 8, which is the retained income. Remember, that is part of our question. We suppose only to do the retained 1.1.2. It is says we must prepare the retained income, and then 1.1.3 says we must prepare the balance sheet. Now, where notes are required, workings must be shown. Please, ladies and gentlemen, show workings inside the brackets. Now let's look at our note number 8. Our note number 8 is retained income, and as you can have a look at it from our answer book here, we need to, firstly to fill in the note. It is not compulsory that you'll get everything filled for you. You must know the format. The format of retained income is balance at the beginning, net profit after tax, net profit after tax, repurchased shares, and then under dividends we have interim and final. Right. Then now, after you have filled in your format, we can go back to our question. Under information C, we have, and then you can even look at the information A, retained income. They gave us an opening balance, an opening balance of 2.2,700,000. Okay, but in our answer book, that has already been recorded for us. It means now we can go straight to information C, dividends and shares. Number one says there that interim dividends of 600,000 were paid on 31st December 2014. So now it means that has already been calculated for us, and then ours will be just to copy and paste to our note, 600,000. Then we go to number two. Number two says here, the directors declared a final dividend of 22 cents per share on 30 June 2015. That is the end of the financial year. Remember, at the end of the financial year, the directors will always, or the company will always declare, a final dividend based on the shares that are in issue at that particular time. Number two, remember, we declare a final dividend at the end of the year, and then that will be paid when? In the next financial year. Shares repurchased on 31st May 2015 do not qualify for final dividends. Right now this, though note number 7 is not part of our question, but for us to be to be precise with our figures, with our number of shares, we need to draw that aside. Now let's quickly draw it. Let's quickly draw our note number 7. You can draw it here, because here we are only interested in the shares at the end of the year. Number 2, we are only interested here. That would also assist us, with regards to repurchase of shares. But for now, let's do the note number 7, ordinary share capital. It says there, on 1 July 2014, the 3 million shares were in issue, and then the value is 3.9 million. That is our beginning of that is at the beginning of our financial year. Remember, the first column of your note number 7, it's where you record the number of shares, and then the last column, it's the value. Here you don't show any calculations here. You must write here 3 million shares in issue at beginning, and then that is 3,900,000. Right? And then let's go back to our question. This is 1 July, at the beginning of the dates are very important on our note number 7. For us, to calculate the correct interim dividend. Remember, interim dividend, yes, in this case, it has already been calculated for us, but in the case where we had to calculate it, very important that we look on, we observe our dates, because remember, interim dividends are paid on the shares that are in issue on that particular date. Now the second one says here, 15 August 2014, 1 million shares were issued at R1.70 each to the value of 1.7 million. Then it will be 1 million. All right. Shares issued during at R1.70, and then it will give you 1,700,000. Right? These are the shares that were issued when 15 August 2014. 15 August 2014. Very important that we write our dates, ladies and gentlemen. Please do not forget to do that. Right? And then on 31st May 2015, 20,000 shares were repurchased at R2.50 each from an existing shareholder. And the amount there paid was 50,000. This has not been recorded. We repurchased shares, 20,000 shares. You put it inside the brackets. Shares repurchased. Repurchased shares. Right? At. Right now, this is a point that I wanted to explain to you. Look at our node number 7, node number 8. We repurchased shares at R2.50. This R2.50, it is the whole price at which shares were repurchased at. But now remember, the company or the directors are in desperate need of these shares. Now even if the shares the shareholder of these 20,000 shares, you'll find out that within this R2.50, it is a little bit more, of the average share price. This R2.50 is a little bit more or on top of the average share price, because now the company had, if the company is in desperate need of the shares, they would go even beyond the average share price just for them to have the shares. But now, hence, we have node number 7 and node number 7 and node number 8. In the ordinary share capital, we must calculate the average share price of these shares. Now, the difference between this average share price and the price at which shares were repurchased at, which is R2.50, will be financed through the retained income of the company. That is what we need to look at. Right. Now, how do we get to the average share price since in this case it has not been given to us? Remember, I told you that this R2.50 here, included in this R2.50, it is the average share price as well as the difference that was topped up on that average share price, just for the company or the directors to buy back these shares. Now, how do we get to that? You add this what took place prior the the repurchase of shares. Then you'll find out that when you say 3,900,000, 3,900,000 plus 1.7 million, it gives you 5,600,000. Then you divide by number of shares, by the total number of shares prior the repurchase, which is 4 million, right? It will give you R1.40, right? Now this average share price, this is how we got to it. We said 3.9 million divided by 4 million, and then we got R1.40. This is the average share price per share. Remember, I said to you, we repurchase shares in the ordinary share capital using average share price. And then you can subtract. Then we'll subtract that from the actual price that the company repurchased these shares. Then you'll say R2.50 minus R1.40, you get R1.10. This is the difference. This is the difference. Now the difference, like I said earlier, the difference is covered through the retained income of the company. Meaning, on your note number 8 here, you'll say open bracket 20,000 times by the difference, which is how much? Which is R1.10. Right. Okay. Then how much will it be? Let's check. 20,000 times R1.10, you get 22,000. You get 22,000. Remember, repurchased shares, we subtract. You put that inside the bracket. Show workings also inside the bracket. Net profit after tax will come from the income statement that we have already calculated. Am I right? Okay, is 1,750,000. Right. Now, with regards to the final dividend, remember I said to you, there's a final dividend that the company declared, that the directors declared, of 22 cents per share at the end of the year. And then shares repurchased on 31st May 2015 do not qualify for final dividend. Right. Now let's go back to our note number 7. Hence, it is important, even though it is not part of the question, but if you can draw it aside, then precisely your answers would be correct. Remember, through note number 7, we'll be able to get how much or how many shares were in issue at the end of the year. Remember, we had 3 million. At the beginning, we issued another million. Then it's 4 million. Then we subtract the repurchase of 20,000. Then we got how much? 3,980,000. These are the shares in issue at the end of the year 30 June 2015. 30 June 2015. Right. Remember, the 22 cents is a final dividend declared on the shares that are in issue at the end of the year. And then they said to us, shares repurchased do not qualify for final dividend. Meaning, we'll work with this 3,980,000 because this balance of 3,980,000 shares excludes shares repurchased. So now our answer there would be 3,980,000 is 875,600 rand. All right. Then, okay, just before I wrap up the if here they said shares repurchased, shares repurchased do qualify for final dividend. It means we could have said now, because now they're saying shares repurchase qualify for final dividend. It means we could have added the 20,000 to this 3,980,000 because now they should get that final or final dividend or their share. But in this case, they do not qualify. Hence, we took the balance that has already excluded the 20,000. Now, going back to our note number 8, we have 600,000 plus 875,600. We have our balance here is 1,475,600. Remember, in our note number 8, we subtract repurchased shares, we subtract dividends. Then we'll have our balance at the end for our retained income. So 2.7 million plus 1,750,000 minus 22,000 minus 1,475,600. Our balance at the end is 2,952,400 rand. All right, that will be your 11 marks. Right. Now going to our balance sheet. That is our note number. That is our. Let's go back to our question. 1.1.3 says that we must prepare the balance sheet on 30 June 2015. Where notes are required, workings must be shown. Now, this is our balance sheet. Before we can even attempt to do our balance sheet, we must transfer the totals from our notes. Firstly, let me start with the retained income. Retained income, remember, our total is 2,952,400. You write it here. You write it here, 2,952,400 rand. Then you'll get 1 mark free. Now, irrespective whether this balance or closing balance is wrong, but for the fact that you took it from the note to the face of our balance sheet, will award you with a mark. And then you add somar, clar, 5,572,000 plus 2,952,400. You get 8,524,400. By adding, you must get another mark, 2 free marks. We are not done yet, right? From our note number 8, this final dividend. Remember, ladies and gentlemen, I said this final dividend, we are declaring it at the end. The company declares this final dividend at the end of the year, and then it will be paid when? In the next financial year. But when we transfer it to the face of our balance sheet. Under current liabilities, we'll call it or we'll record it as shareholders for dividends. Shareholders for dividends. And then how much is it? It is 875,600 rand. For the fact that you took it from your note and then you place it correctly on the face of your balance sheet, you'll get another mark. 3 marks so far for free, right? And then we go back to our income statement. Let's go back to our income statement. Remember, we had this. We had the trading stock deficit. But let's check how much was our stock at the end of the year. It is 191,900. It is 191,000. That was our closing stock. You don't take the trading stock deficit to the face of your balance sheet, but what you must take it is the closing balance. The closing balance to your balance sheet to the value of how much? 191,900. 191,900. Right. That's another mark. Right. Then you go back to your income statement. Remember, we had provision for bad debts of 2,400 rand. Now, 2,400 rand that we have added back. But on your face of your balance sheet, you don't record the difference, but you record the actual provision for bad debts adjustment, which is 9,000. And the 9,000, remember this 9,000 of provision for bad debts, it decreases our debtors control. And then, but now on the face of our balance sheet, we don't have debtors control, but you must open bracket and then subtract that 9,000. This decreases our debtors control. And we're not going to have debtors control or creditors control on our face of our balance sheet, but we'll have trading and other receivables that will fall under current assets. In this bracket, you'll include debtors control, you'll include prepaid expense, you'll include accrued income. All I remember on the face of the income statement is prepaid expense we subtract, yes, accrued income we add. But here on our balance sheet, all of them we add. We record them in the respective brackets, but we add one sign for all of them. And then under current liabilities, we're not going to have, yes, we'll open bracket. We're not going to have trading stock. We're not going to have creditors control. And then accrued expense, income received in advance individually. No. We'll have trade and other payables. And then inside the bracket here, that's where now we'll record our creditors control. That's where in that bracket we'll add accrued expense if we have. That's where we'll add again income received in advance. All of them fall under one bracket, and then we add all of them. We add all of them. Now, I was there at I've just recorded the provision for bad debts, and then we have this rent income. Remember, this rent income was income that we have received in advance. On our face of our balance sheet, income received in advance falls under trade and other payables. And then I said to you, we add. So it will be 2,800 here. And then it is insurance. Insurance, this was that prepaid of 4,500. So that one will add where under current assets in the bracket of trade and other receivables. So now we'll add here 4,500 rand, right? So these are free marks. Let's count so far. How many marks do we have for free? 4, 6, 7. 7 so far, right? Then we go. We are done transferring the totals from our notes. Now let's go check our question. Let's go check our question. Our question, information A. The ordinary share capital, it has already been given to us. We must now transfer the balances here again to the face of the balance sheet. And then we have retained income that we already did, and then there's mortgage loan. Loan, remember, on the face of our balance sheet falls under non-current liabilities. You'll say there a loan, and then open bracket. You write the amount of loan there. It is 262,200. By transferring the balance there, you get another free mark. Then we go to fixed assets. It has already been given to us. It has already been given to us. Then we go back, and it's trading stock. Trading stock, remember, falls under current assets. It falls under current assets, and then we took the latest or the closing balance that we got from our adjustments. Right, and then it is debtors control. Debtors control on our face of our balance sheet falls under trade and other receivables. Falls under trade and other receivables, and then it is 316,000. It means here you must now add 316,000, right? And then we go back. We go back, and it's provision for bad debts. Remember, we took the adjustment one from the adjustment, and then we have subtracted. We have recorded that as negative here because provision for bad debts decreases our debtors control, right? And then it's cash and cash equivalent. It is a balancing figure. It is a balancing figure. Remember that. You can just say here asterisk, and then it is a balancing figure. Right? It's a balancing figure. Remember that one. And then it is SARS income tax. Now, here, these are provisional tax payments. These are this 725,000. It is the tax payments that the company did during the course of the year, which is how much? 725,000. The correct income tax comes from the income statement. The correct income tax comes from the income statement, and then the company is supposed to pay how much? 750,000. But look, the company paid so far how much? Provisionally, 725,000. So it means they still have to pay the difference, which is 25,000. 750,000 minus 725,000, you get 25,000. Now, this 25,000, it is the tax that the company still, have to pay to SARS. That is why we will record that under current liabilities as SARS income tax. Remember to show your workings inside the bracket. It gives you 25,000 here. 3 marks so far. We'll count how many free marks we got by only transferring income receivable of 5,200 rand. Income receivable name that is accrued income. Accrued income, prepaid expense, they fall under trade and other receivables in our balance sheet, and then we add all of them. We must add all of them. Here we'll add 5,200. Here we'll add 5,200, right? And then the last one would be the creditors control. Remember, creditors control, accrued expense, income received in advance. On our face of our balance sheet, we'll record under current liabilities in the bracket of trade and other payables. It means now we must add this 261,000 here, 261,000 there. Now we are done transferring the information from our information A. We done transferring the balances. Now I want us to quickly check how many free marks this question comes with. We have here 2, 4, 5, 7, 9, 10, 11, 12, 13, 14. Out of 30 marks allocated for this balance sheet, we have 14. We have 14 free marks. Right. Now we can go back to our question. We're done with A, we're done with B, we're done with C, and then there's this one now, D. D says a debtor's debit balance of 1,000 in the debtor's ledger must still be transferred to his account in the creditor's ledger. Look, we are transferring a debit balance of a debtor here. Our calculation is, and then we are transferring it to the creditor's ledger. Now, let us check. We have a debtor here. Debtor, remember, it is an asset account. It increases on the debit side, decreases on the credit side. This debtor had 1,000 debit balance. We have 1,000 debit balance. Right. Now, it has to be transferred to the creditors ledger. Creditor, it is a liability account. It increases on the credit side, decreases on the debit side. Now, when you transfer this debit balance here to the creditor, on the side of the debtor it is positive, and then on the side of the creditor it is negative. Now, how do we record that here? Because we are transferring it, it means now we must subtract 1,000 here, and then on our creditors ledger, look at our creditors ledger. It is now negative. It is negative 1,000. It is negative 1,000. So now here we'll have again here minus 1,000. Right. Now we go to E. The mortgage loan from Custom Bank was obtained on 1 April 2014. This will be repaid over 6 years. A fixed loan repayment excluding interest is made at the end of each month. The first monthly loan repayment was made on 30 April 2014. All other loan repayments have been made. Interest is not capitalized and has been correctly recorded. Now we must calculate now. Remember, this is our loan. This is our loan. This is our loan. This is our loan. It was first obtained on 1 April 2014, right? To our financial year end is 30 June 2015. Right, let's check. From 1st of April 2014 to 30 June 2014. That is our that is our first year. All right. The second financial year will be from 1 July 2014 to 30 June 2015. All right. This second day, it is our current financial year. Remember, this loan is to be repaid over. This loan is to be repaid over 6 years. Now let us look how many installments did we pay for the first year. Remember this installment, this side. From April to June, April, May, June, it is 3 months. 3 installments for that year. We took loan in that year, and then we paid it for in the last term of our financial year. Second year, which is our current financial year, it is full. It is supposed to be 12, right? And then we have the total installment is 15. Remember, the loan is for 6 years. When you say 6 times 12, you'll find out that 6 years equal to 72 installments, right? Right. So now we took, we already paid 15. We paid 15, and then we are left with, when we say 72 minus 15, we are left with 57. That is the balance of our installment to date, which is 30 June 2015. But now let's look at the balance of our loan. The balance of our loan is 262,200, right? 262,200, that is our loan, ne? 262,200. Remember, we are paying 72 equal installments. Now, we'll divide this by 57 to get how many installments, to get how much is installment, ne, over this, the remaining term of 57 months. Ne? So it will be 262,200 divided by 57. You get 4,600 rand. That is for 1 month. I get. It means for a year it will be how much? It will be 4,600 times by 12. It is 55,200. Within in the next financial year, it means this is what we are going to pay towards our balance of our loan, which is 55,200 rand. Right now, on our face of our balance sheet, what will be paying in the next 12 months? Is that amount here, 55,200. 55,200. We subtract it here. And then it is, the balance would be 262,200 minus 55,200. You get 207,000. This, what we have subtracted here, under current liabilities, we're going to call it current portion of loan. Current portion of loan, it is 55,200 rand. Right. So one here and then one there. Right. And then let's go back to our question, ladies and gentlemen. We have reached the end of our balance sheet. It means now we must close off our balance sheet. When we close off our balance sheet, firstly we close off the brackets. We close off the brackets, right? Right now, let us check. We have equity and liabilities. We have non-current liabilities, and then we must now add this trade and other payables so that we can have current liabilities. So now it will be 2,800 plus 261,000 minus 1,000. It will give you 262,800. Then we add 262,800 plus 875,600 plus 25,000 plus 55,200. You get 1,218,600 rand. Right. Now, since we have equity and liabilities, non-current liabilities, current liabilities means we can have our total equity and liabilities, which is 8,524,400 plus 207,000 plus 1,218,600. You will have a total of 9,950,000. Remember, this is the balance sheet. Total equity and liabilities must equal your total assets. So now you take the very same answer here, 2 as your total of total assets. 9,950,000 950,000. Right. Remember, the balancing figure is the cash and cash equivalent. Now, let's work out trade and other payables. In your calculator, remember, you're supposed to say negative 9,000. That negative is the provision for bad debt adjustment. Remember, I said it decreases our debtors control. Negative 9,000 plus 4,500 plus 316,000 plus 5,200 minus 1,000. You're supposed to get 315,700. Right, case closed. Now, we check now. Look, we have total assets. Remember, for us to get total assets, you're supposed to say non-current assets plus current assets, you'll get your total assets. But now, you check. For us to arrive here, it means you're simply supposed to say 9,950,000 minus 8,950,000. So it means now your current assets is 1 million. Now, remember this total assets of 1 million. It is the total for your inventory, trade and other receivables, and cash equivalents. Now, remember, cash and cash equivalent, it is the balancing figure. So it simply means now you're supposed to say 1 million minus 191,900 minus 315,700. You'll get 492,400 as your balancing figure. Now, 1 mark. All right. Now we are done with our balance sheet. We're done with our balance sheet. Let's quickly look at the audit reports. It's just for 6 marks. It's added to this question now, right? It's added to this question now. Right, just brief name. Remember, audit reports. Under audit reports, there's a difference between external auditor and internal auditor. Now, what is the difference between the two? Internal auditor, it is a full-time employee of the company. His is only to identify the risks in the company, assess controls, recommend and assess controls in order for the company to minimize the risk from taking place. That is the main job of the internal auditor. And then in terms of reporting, he reports to the chief audit executive. Like I said earlier, he is full-time employee of the company, or employed by the company. Now, external auditor, who is this person? The external auditor comes at the end of the financial year. Is an independent auditor that comes at the end of the financial year. His is only to express an opinion on our financial statements. Now, there are 3 opinions that he or she, as the company, is expected from him or her. One, it will be a disclaimer disclaimer is whereby a disclaimer audit report is whereby not at all the external auditor is able to express an opinion. Now, secondly, we have unqualified audit opinion. Unqualified audit opinion is whereby now the external auditor, this independent auditor, is able, to express an audit opinion. Now, in this regard, it will be that if financial statements are fairly presented, and in terms of international financial reporting standards, that GAP principles were adhered to in the reporting, and then the third one would be qualified report. In this one here, the external auditor or the independent auditor is not able, is partially able to issue out an audit report, or cannot be able to issue out a audit report pending, some audit evidence that she needs to that needs to be attended to. So it's different from this one of disclaimer. Disclaimer, not at all he or she is able to express an opinion. Here, she is able to express an opinion, but with some recommendations to say on this aspect, follow-up still needs to be done. Or still he or she still have to be furnished with an audit evidence, right? Now let's quickly look at this question here. It says choose the correct weight from the given those given in brackets, give a reason, and then 2 says explain 2 consequences of this audit report for the company or the CEO. Now let's look at the extract from the report of the independent auditors. The company procurement policy states that purchase over 100,000 must be approved by the board of directors and supported by 3 quotations from the independent suppliers. During the year under review, the company purchased 2 vehicles at the cost of 900,000. This was approved by the CEO without reference to the board. Only 1 quotation was received. And then remember, the policy says anything that is 100,000 or beyond must be approved by the board of directors and be supported with 3 quotations from independent suppliers. But now what the CEO did, he authorized a purchase of 2 vehicles to the value of 900,000, and this was done without even getting approval from the board as far as the policy of procurement is concerned. And whereas only 1 quotation, it was that 900,000 was approved with only 1 quotation. Now, here is the audit opinion. Because of the significance of this matter, we have not been able to obtain sufficient audit evidence to provide a basis of an opinion. I start again. We have not been able to obtain sufficient audit evidence to provide a basis for an opinion. Accordingly, we do not express an opinion on the financial statement of Trimex Limited for the year ended 30 June 2015. Now the question says here, we must choose a weight from these 3 audit type of opinions. So now, because the auditor is clearly stated here. No, we do not express an opinion on the financial statements. They do not express, and so now it is a disclaimer. Now remember, disclaimer, not at all audit opinion can be expressed by the auditor. Now, give a reason for that. It's 2 marks. I get it. Auditors when were unable to express an opinion because there was insufficient audit evidence. That is the reason. Name. That is the reason. Name. Auditors were unable to express an opinion due to insufficient audit evidence. Now, due to insufficient audit evidence. Right. This is 2 marks. And then 1.2.2 says explain 2 consequences of this report for the company and the CEO. Obviously, ladies and gentlemen, this is a better report for the company. Now, what are 2 consequences? One of the consequences would be that the directors will have to account, or will be held accountable. Directors will be held accountable. And then one other reason would be that this would be a bad publicity for the company name. This will be a bad publicity for the company. And then one other consequence would be that, this would drop, the share price at the JSE, and even the demand of shares from the from the public. Share price will drop at JSE, and the demand, and this would also affect the demand of shares from the public. Right? So that will be it. That will be it. We have more than one consequences, ladies and gentlemen, and one other. Okay, in addition for that would be that investors will have no confidence, in the management of the company. So now, audit reports play a very important role towards the growth of the company. So now that will be it for the balance sheet. Let's take a break, and then after that we'll look at note number 3, fixed asset, very quickly. Thank you very much.
All right.
Okay, just 5 minutes and.
in 3, 2, 1.
Welcome back, ladies and gentlemen. Now we'll be looking at the fixed assets, management and internal controls. Basically, it is our note number 3. Without any waste of time, let's quickly look at our question. The question says that the fixed asset information appeared in the books of Lala Traders for the financial year ended 30 June 2016. Very important, identify when is the end of your financial year and when is the beginning of your financial year. The beginning of the financial year will be 1 July 2015, a day after the end of our financial period. Now we are required to prepare the asset disposal account to take into account the trading equipment on 1 March 2016. Right. Now let's look at the equipment. Let's look at the equipment here. They say on 1 March 2016, old equipment repurchased on 1 July 2012 were traded in for new equipment valued at 160,000. The trading value received was 58,200. The accumulated depreciation on this equipment on 1 July 2015 was 27,000. Equipment is depreciated at 15% on the carrying value. Now, this is our asset disposal. Remember, the purpose of our asset disposal is to check upon the sale of an asset or upon disposing of an asset, whether we did profit or a loss. Now, on the debit side of the T account, we'll have the cost price. And then on the credit side, we'll have the accumulated depreciation to date. Now, what's the difference between accumulated depreciation and the depreciation? The depreciation is what we calculate for the current financial year. Is what we are going to calculate for our current financial year. Accumulated is the depreciation from prior years, from the date on which that particular asset was bought up until the last day of last year's financial year. So this year it is we calculate depreciation for the current year, and then when we go to the following year, what the depreciation that we have calculated this year would be added to the accumulated depreciation balance of last year, and then for that year we'll have to calculate another or a new depreciation. That is the difference between depreciation and the accumulated depreciation. Now let's look at the equipment here. Let's look at the equipment here. They say here, on 1 March 2016, old equipment purchased on 1 July 2012 was traded in for new vehicle valued at 160,000. The trading value received was 58,200. The accumulated depreciation on this equipment on 1 July 2015 was 27,000. Now, let's quickly record that in our, remember I said here, on the credit side, it will be the accumulated depreciation to date. In this case, they said is 27,000. It means now we must calculate the current year's depreciation. It means we must calculate the current year's depreciation. Number two, when we traded in this equipment, they gave us a trading value of 58,200. 200. Now, on the credit side of your T account, you'll write the creditors control, ne? Because now we traded in the equipment in exchange of a new equipment to the value of 160,000. It means out of 160,000, they will cut off 58,200, and then the business will be financed with the balance. Right now, let's calculate the cost price. Now, through your note number 3, you'll realize that yes, we sold equipment, but we need to know how much was the original cost price of that equipment. So now you're supposed to say cost at the beginning plus additions minus cost at the end. Then you'll get your original cost price of the equipment sold. So it will be 420,000 plus 160,000 minus 490,000. You get 90,000. In other words, the original cost price of your asset of that equipment is 90,000. And again, let's look here. They say equipment is depreciated at 15% on the carrying value. Remember, carrying value means now we're supposed to say cost price minus accumulated depreciation. Then you'll get your carrying value. Out of this carrying value, it's then now you can multiply by 15 and then divide by 100. Now let's look at that. We're supposed to say 90,000 minus 27,000 times 15%. And then remember, we had this equipment when? When did we have this equipment? We had it from the beginning of our financial year, but up until when? We did not have it for the whole year. We had it up until 1 March 2016. On 1 March 2016, all equipment purchased on 1 July 2020 were started in. Yes, we had it up until 1 March. For this year, for our current financial year, we had it from July, August, September, October, November, December, January, and February. So we had it for 8 months. We had it for 8 months. And then remember, our depreciation method is we depreciate it's a diminishing balance method, meaning we calculate our depreciation on the carrying value. So 90,000 minus 27,000 times 8 divided by 12, you're supposed to get let me quickly look. 90,000 minus 27,000 and then times 15 divided by 100 times 8 divided by 12. You're supposed to get 6,300. What we said is 90,000 minus 27,000 gives us 63,000, right? Then this 63,000 we times by 15 divided by 100 times by 8 divided by 12. We only had this equipment in our financial year, in our current financial year, for 8 months. Hence we multiply by 8 and then we divide by 12. So now we got 6,300. Right. Remember the purpose of asset disposal. The purpose of asset disposal is to arrive at a point where we determine whether upon the sale of this particular asset, we did profit or a loss. On the debit side, it is the original cost price of that particular asset, and then on the credit side, it will be accumulated depreciation to date, meaning from the day it was bought up until the last day it was sold. So now here, on the credit side, we'll have 27,000 plus 6,300. It is 33,300. Right. Now, then we can balance and then check whether we did profit or a loss. So when you say 33,300 plus 58,200, you get 91,500. You get 91,500. You write a bigger amount on both sides. So the smaller side is on the debit side. So now, if our balance carry down is on the debit side, then it means it is a profit. So here you'll write profit on sale. 91,500 minus 90,000, you'll get 1,500 rand. Right. Now let's move to 6.2. Calculate the missing amount denoted A to D on the incomplete fixed asset note provided. Now let's quickly look at A. Our A is there, right? Our A, it's additions, land and buildings. Look, now how do you know whether the business has acquired some land or buildings? Look at the carrying value at the beginning or cost at the beginning, and then compare it with the cost at the end. You'll see that at the beginning it was 1.3 million, but at the end now it was now 1,750,000. It means they've acquired land and buildings. So that difference will be between the two figures will be our answer. Right. Now let's check. We have 1,750,000 minus 1,300,000. 1,750,000 minus 1,300,000, you get 450,000. So the 450,000 is our additions. The 450,000, it is our additions, right? Okay. Now we check. Now we must check. We must now check the. Let's look at B. Now B is looking for accumulated depreciation on vehicles. Now let's look at the beginning, obviously. Remember your note number 3. This first part here of carrying value at the beginning. This is our opening. Again. And then under movements here, it is during the year. And then carrying value at the end, that will be our closing. Right. Now vehicles says here, the vehicles at the beginning of the year, 520,000 were repurchased on 1 July 2012. Were repurchased on 1 July 2012. And then the new vehicle was purchased on the 1st January 2016. No vehicles were sold during the year. Vehicles are depreciated at 10% on cost. That is what we are interested on here. Remember, here, opening this 520,000 is the total value of our vehicles. Now, what we want here, we want accumulated depreciation at the beginning of the year. And hence, depreciation method is important. In this case, it's 10% percent per annum that is calculated on cost. It means now what we will do, we'll simply say, we'll simply have to count, the depreciation from 1 July 2012. Remember, our current financial year is 1 July 2015. Now, we must calculate the depreciation from 1 July 2012 to 30 June 2015, just before the current financial year. Now, when you say 1 July 2012 to 30 June 2013, that is our first year. Second year is 1 July 2013 to 30 June 2014. And then third year, it will be 1 July 2014 to 30 June 2015. That is a day before the current financial year. Right. Now remember, it is 10% on cost, meaning it is a straight line method. So now the value is 520,000. That is the value of our vehicles. Times 10% divided by 100, you'll get 52,000. Now this 52,000, it is a depreciation per year. Remember, we want depreciation for the past 3 years. Year 1, year 2013, 2014, 2015. Then it means now we must times by 3 here, and then you'll get 156,000. Right. C. Let's look at C. C. It's C. Where is our C? Disposal. The equipment, disposal on our equipment. Let's go back to our T account of asset disposal. Remember, here we want it is a disposal at carrying value, meaning disposal at carrying value means we must now say the original cost price minus depreciation to date. Then you'll get your disposal at carrying value. So it is 90,000 minus 33,300. It will be 90,000 minus 33,300. So now it will be 56,700. All right. Then let's look at D. Let's look at our D. D is looking for, it is a depreciation. Now, depreciation during the year, remember, we need to have depreciation for old, and then we need to calculate depreciation for sold. Now, if we have sold any asset during the year, and then we need to calculate depreciation for new, if we bought any asset, and then take into consideration the depreciation method. Remember, with equipment, we are using diminishing balance method. We calculate depreciation on the carrying value. Now, let us start with old. Old is here under opening. It is your 420,000 is your cost minus accumulated depreciation. 420,000 minus sold. Remember, we sold most equipment to the value of 90,000, right? With accumulated depreciation of 27,000, not 33,300, because this total here includes 6,300 of the depreciation. Remember now, we are now working with the opening name. Hence we need to say 186,000, and then we subtract our accumulated depreciation of 186. Accumulated depreciation of 186,000, and then we subtract accumulated depreciation of the sold of 27,000. 27,000. Here we'll subtract 90,000 cost price of equipment sold. And then it will leave us with 420,000 minus 90,000 is 330,000. And then 186,000 minus 27,000, it is 159,000. So now it means our new carrying value that excludes the new carrying value that excludes cost price of equipment sold and accumulated depreciation sold will be 330,000 minus 159,000. You get 126,000. This 126,000 now you can now multiply by 15 divided by 100. You'll get your depreciation for old. 18,900. 186,000 gives us 330,000 minus 159,000. Get 171. Sorry. Here it's 171,000. Now this 171,000 times by 15 divided by 100, you get 25,650. So this is your depreciation for old. And then remember, we bought new equipment to the value of 160,000. We bought new equipment to the value of 160,000 on 1 March 2016. Now it means now we had this new vehicle for how many months? March, April, May, June. We had it for 4 months in our current financial year. So we'll multiply by 4 divided by 12 here to get 160,000 times 15 divided by 100 times 4 divided by 12 to get 8,000. It means the depreciation for our new is 8,000, right? And then sold is we'll get it from our T account. Remember, we calculated 6,300 as our current year's depreciation. So sold is 6,300. Therefore, total depreciation will be 25,650 plus 8,000 plus 6,300. And then you write the total on this box given to you. So now the total would be 33,950. Right. Right. And then lastly, it is an internal control question that says there, provide a suitable reason why the business would dispose or sell fixed assets. The business would sell their fixed asset due to a number of reasons. Among those reasons would be that to upgrade, in order to upgrade for to upgrade for a new to a new technology, among other reasons would be that for the business to, when the assets are no longer or are just redundant, that would be another reason that these assets are just sitting there and are no longer useful. So that would be another reason. When assets are redundant, or no longer useful. 3 would be when now the maintenance or the service of these particular assets are no longer economical. That would be another reason why would the business sell their assets. When repairs or maintenance is no longer economical. Right. Now, ladies and gentlemen, thank you very much for your time and patience throughout these 2 sessions. Indeed, it was, I hope the session would be fruitful to you. And thank you very much. We'll meet next time. Thank you very much.